All right, so class, you are welcome and good morning. And we want to journey through the preparation of a financial statement. All right, so we are going to look at some adjustments you do before you prepare a financial statement. And we are going to start from the very first time we met, which is the introduction, and we dealt with an accounting equation. So we are going to start with the same accounting equation: assets are equal to capital. We use capital when it is a sole proprietor, but if it is a company, you use what? Equity. All right. Plus liability or liabilities. All right. So this is the accounting equation. And this equation, if you remember in our accounting equation lecture, I told you that this is the equation we use to prepare a balance sheet. All right, so take note of that. So what we are basically trying to do is that we are going to journey towards the preparation of a balance sheet. But in assets, we learned that there are two types of assets, right? We learned that there is non-current assets and there is what? Current assets. All right. So our adjustment today will be based on current assets. All right. So that is what we are going to look at. Now, under non-current assets, so we are looking at non-current assets, sorry, we have two types of non-current assets. We have the tangible non-current assets, those that you can see. So tangible non-current assets, it means these ones we can see, we can touch. All right, they are visible. Then we have the intangible non-current assets. So those ones we cannot see, we cannot touch. They are invincible. All right, so that is that. In terms of feeling and touching. All right, let me not say you cannot see, but you can probably see, because when you have a software, you can probably have a sight of. But this one, what we are saying is that you can't touch them. All right, let me probably put it that way. Okay, so these are the tangible non-current asset and the intangible. Now, let's get some examples there. All right, when we pick the tangible non-current asset, what are some of the examples that you remember? My guess is that you remember your motor vehicle. You remember something like plant and machinery. You remember something like your equipment, which includes computers and stuff. All right. You may remember something like furniture and fittings. All right. You may remember something like land and buildings. So all these things are example. You can continue and add, but most of them might probably fall under equipment, like your computer equipment, television. All right. If you look at your room, you have fan. These are fittings, furniture. You have them. All right. Things that make your room. Fans are equipment. Things that make your room also jive, or your office also work to amusement. All these things are examples of tangible non-current assets. Now, these ones are not a problem, but the thing that we need to understand is that for each non-current asset, what we need to do is that we need to understand that at one point, it start by purchasing them. So you need to purchase. And in accounting, when you purchase a non-current asset, the correct terminology is actually an acquisition. So you acquired. All right. So basically, that is that. And this is what we learned from the basic level, what we've been doing, that if a company acquires an asset, a non-current asset, we will have to get the cost of that. So initially, you measure it. You remember measurement, attaching monetary value to the item. So you measure it at cost. All right. And we are going to go in very soon to talk about cost. Now, before I even move further, you do know that these non-current assets that we are referring to, these are the assets that are purchased for production. All right. So you could see that non-current assets, we are talking about assets that are used, tangible assets that are used for production of goods and services. Of goods and services. They are actually used for the production of. So if you pick your motor vehicle, you see that you are using it to run a service, plant and machinery production, equipment, all these things, they are used usually for production of goods and services or for administrative purposes. Administrative purposes. Sometimes too, you can rent it, so or for rental. So we say that, as you can see, we purchase these things for long term. So these are assets that are purchased for long term use of a business. So we are using it for long term, not just 12 months, but we are using it for long term. It is acquired for long term. All right. Number two, they are used, as you can see, to improve or enhance productivity. That is generation of income. All right. They are used to improve or enhance. And you will see that because of that, the benefit from using the asset, benefits from NCA are more than 12 months. Are more than 12 months. Are more than 12 months. So that is what you can see. The benefit that comes out of it are usually out more than 12 months. And because of that, we call the purchase or the acquisition of such a capital expenditure. We call it capital expenditure. So what is a capital expenditure? Capital expenditure simply means expenditure that is made on non-current assets that is long-term. It is to improve or enhance productivity, and for which the benefit from that asset will be more than 12 months. So that is what we mean by a capital expenditure. So when you purchase those ones, you see, it is not recurring. You don't normally do it. It's not what you do every day or as a business in your ordinary course of activity. No, that is not it. But you see, you buy it and it is for long term. You buy it and probably is to improve your asset. All right. So basically, that is that. So this is not to maintain the asset or to renew the asset. Okay. So sometimes you just do something just to make the asset look new or maintain or sustain it. That one is different. Those ones we will look at it when we are dealing with the current asset part, especially on inventory. All right, we will look at something like that. But bear in mind that if you do any expenditure for which the benefit of that expenditure is going to last for more than 12 months or 1 year, then that expenditure is a capital expenditure. So take note of that. And mostly these are expenditures that are on non-current assets. Take note of that. All right, so that is that. Now, that is the understanding you need to get about capital expenditure. All right, I hope that is fine. So you have capital expenditure, including expenditures that are on assets that are not for resale. They are expenditure on assets that are not for resale. The benefit is more than 12 months. Okay, they are for long term. So the opposite of capital expenditure will be what? Revenue expenditure. That means that for those ones, they are spent on asset. They are recurring. All right, it's every day. So or every year. If you pay rent, for example, this year, you pay rent next year. So those ones are recurring. We pay electricity recurring. All right. So you see that those ones, it is always revolving. All right. So that is that. Now let's come to the next thing here, which is cost. Now, what is cost? Cost simply means sacrifice. All right. How much you sacrifice to get something. All right. So that is what cost is. That is what cost is. So the amount of sacrifice that you have made. Now, the value of that sacrifice will be called price. All right. Price. So cost is the sacrifices you made to get an asset or to bring an asset to a point where you can use it. So let's say I live in Tema. So let's say I need to go to Accra, all right, to buy something, a non-current asset. So take, for example, I'm going to buy a motor vehicle, let's say a car, and I go to Accra and I buy the car. The sacrifice I'm making is that I could have stayed in my room and enjoyed television, movies, or anything, but I've made a sacrifice to go to Accra. So that place, moving from here to Accra, is a sacrifice. The money that I will use to buy the car, I could have used it to buy something else. So that one too is a sacrifice. When I bring the car to Tema, it's a sacrifice. So everything is a sacrifice. Now, the value of that sacrifice will be the price that I have to pay. All right. So take note of that. And so when we say cost, cost doesn't only involve the purchase price, but because I can't sit here and I just pay. And even if I sit here and I pay, they would deliver it to me. And sometimes they charge deliveries. All right. So that's how it works. All right. So when we say cost of a non-current asset, then it means that it is going to include the purchase price. So cost is the purchase price. The purchase price. Now, if they gave you any discount, you have to deduct that discount. So we say cost less or minus trade discount. Please, you see, I didn't say cash discount. I said what? Trade discount. So the purchase price, then you less any trade discount. So you have that. But if there is delivery, you have to add it. Number two, delivery. All right. So delivery cost, you have to add that delivery. All right. That is that. So these are, and any other subsequent cost, let me say any subsequent cost for improving, and the word improving or enhancing the asset. All right. So you must understand that. For example, and I'm going to cite so many examples, and these are under capital expenditure. So all these things that you see, they are all expenditures that are capital expenditure. So let's say I have a car, I've used it for a long time, and I'm focusing on this one. And I now decide to go and change the engine of the car, buy a new car. You see, engines have capacity, all right, capacity. So let's say my capacity was down before and I went to buy a new engine. So you will see that I'm coming to now improve, all right. It is not a repairs. We do repairs to actually maintain the asset, okay. So that is that maintenance. But when I buy a new engine, I'm just not maintaining the asset. I'm improving the value of the asset because the car, the sound of the car and everything becomes new. So, and it will let the car in terms of how much it is going to last increase with years. Have you seen that? By a normal repair, let's say I'm going to fix my tie, it is something you can do within the year again. So it is not a long-term thing. So get the difference right. But if you buy a new engine, you see that you have improved, all right, the car. All right. So basically that is that. That is that. And another thing that is dicey here is that, for example, and I'm going to cite some example with this. When you buy a car, so you have the purchase price, let's say 30,000. You see, you have to license the car and you have to what do insurance. Let's say together these two is 5,000 Ghana cedis. You will have to add it to get 35,000, and this will become the cost. Now you see the license and the insurance, they are also something that you'll be doing all the time, because every year you will have to go and pay DVLA, roadworthy, and also do insurance of the car. All right. So that is that. You go to the Driver Vehicle License Authority, DVLA, and you have to be doing these things every year. But you see, when we said the definition of a cost, we said that it includes all costs or all sacrifices incurred in bringing the asset to its useful state, all expenses you incur to bring the asset, in this case our NCA, to useful state. That is to a point where we can use it. So, and these are some of the costs to a point where we can use it. So now, if you buy a car and you don't do the license and the insurance, you cannot use it on our road. So the very first one that you will do will be part of the cost of the asset. It's like building a building. All right. So when you build and paint, the very first painting will be part of the cost of the asset because you did it with it. But if you do repainting, that one will not be part of the cost of the asset. You will have to treat it as a revenue expenditure. All right. So that is that. And this one's to subsequent license that you are doing. It doesn't improve the car. The insurance will not improve the car. All right. So, but if it were supposed to improve the car, like we talked about changing an engine, then it will be part of the cost of the asset. So these ones, because you have to do it for the first time to bring the asset to its useful state, that is why these ones are classified as part of the cost of the asset. All right. So take note of that. Sometimes when you are buying a land, you have to pay legal fees and all that. So these are what you need to take note as part of what the cost of the asset. Any other thing aside these things will be expenditure. Now let's pick an example. I have an example here for you. Let's pick an example and work at it. So look at this example about an acquisition. It says that we have Bilbo Baggins started a business, all right, in providing limousine taxi services on 1st January 20 X5. In the year to 31st December 20X5, the following costs happen. Office premises, 250. Legal fees associated with the purchase of the office, 10. Cost of material and labor to paint the office in Bibo's favorite color, which is purple, is 300. Now, Mercedes E-Series estate cars. So this is it. So you have this and you have number plate 210, delivery charges 180, road license fee for the car. Then you have driver's wages for the first year of operation. Then you have blank taxi receipt printed with Bibo's business name, all right, for 450. Now it says that what amount should be capitalized in land and building and motor vehicle. So we are trying to learn cost, all right? So cost, so here we have two assets. We have land and building, and we have motor vehicle. So what we are trying to do is to learn about cost, but usually you'll be giving these costs directly. You won't have to suffer, but just in case, all right, then we have what? Motor vehicle. All right, so we need to add to see how much we will classify as part of our motor vehicle. So when you pick the land and building, of course, the office premises, how much did it cost? 250,000. So that one will be part of the land and the building. Legal fees associated with the purchase, should it be part? So that is the question you ask yourself. So we said that the purchase price and any other cost you incur to be able to have the asset and use the asset. So look at this. Legal fee, yes, of course, because if you don't have, if without the legal fees to help you with the purchase of the asset, you will not get the asset. So 10,000. But let's look at the cost of material and labor to paint office in Bilbao's favorite color. That one will be a revenue expenditure, not a capital expenditure. Why? Because this is a building you have purchased. So it means that the building is already in existence. Probably what you are trying to do is repainting because you want to change the building to your favorite color or paint it to your favorite color. And your favorite color can change anytime and you can be repainting. So this one will not be part of the cost of the asset. All right. So take note of that. Why? Because the asset has already been made available for use. You are just trying to repaint it, and these are repaintings that will happen. So they will be recurring, and we said so here we will have 200 and what 60,000. So that will be our cost. Let's go to the motor vehicle. Mercedes Benz estate cars, e-estate cars. So if you will it be part? Of course, it will be part because that is the cost of the car. That is 100 and what 16,000. You have that. The number plate of the car. Without a number plate, can you use the car? So those are the questions you need to ask yourself. Without the number plate, can you use the car? So if you can't use the car, then it means that that one too will be part of the cost of the asset. So you need to add that one down. So that will be what? 210, right? So that will be it. Then we have delivery charge for cars. So does it mean if the car is being delivered to you, how much will you pay? All right. So that is that. So that one, you will also have to add that value. Okay. So that will be that. Now, road license fee for cars is here. Then we have driver's wage. Now, this road license fee for cars, if it is not the initial one, all right, because the thing is that now you have brought the asset to each useful state. You can actually use the asset. So the road license fee is something you must be careful about, that if this road license fee is part of the initial road license. So this one is a general statement road license fee for cars. But if it is for the first one that you are doing, then it will be part of the car. But if it is not for the first one that you are doing, so that you can actually use the car, then you can ignore it. But as a general statement like this, you will have to ignore it. All right. So that is that. But if it is the first time, don't forget. So those are things you have to be careful about. So here we have 116 and I have 390. So you see 260, 390. So our answer will be what? A. All right. So that is that. But if the road license fee is the very first one, then hey, we need to be careful. All right. So basically, that is that. So if it's for the, but here you see that road license fee for cars. I think that if he had made it for the road license fee for this specific car, for the first time usage, we would have added it. All right. So be careful. All right. Just be careful. As for wages of the driver, it's recurring. All right. So is the asset. The asset is already useful. So if you are using it, you are now using it, but it has always been useful. All right. And a blank taxi receipt printed with Bibal's business name, like the way they do business card. All right. So those ones too are revenue expenditures. All right. So that is that. So you have to be careful about it. In any case, you realize that when you add the four and when you add a 480, you will be getting, so it won't even match. The closest one to match would have been D, but this is the problem. So you see, if this one too was a first painting as part of the building already, this one, the building is already there, you are repainting. So if you bought it inclusive of the painted building, then that one will be part of the cost of that. So get uh, the distinction very clear. We will be seeing more, especially in accounting 2, which will be done in next semester. You'll be seeing more of that. All right. So basically that is that. So that's it for determination of cost. Now, once you have the cost, how are you going to treat the cost in your financial statement? All right. Once you have cost, remember how we used to do it. So the recording, how do we record it? We record by debiting the asset, the NCA. All right. You will debit the asset because what has happened? The asset has increased. And anytime asset increase, what do? We debit it. So will you credit? Your cash bank, right? So cash and bank, or bank if you bought it with them. But what if you bought it on credit? The credit will be a creditor. All right. So a payable. All right. And if it is on credit, then it means you have to use a general journal. Or if you are preparing an account, you have to have the asset and the person you bought on credit from as your payable. All right. So basically, that is that. So with this one, for example, this asset. So we will open the asset account. Our asset is what? Motor vehicle, land and building, and motor vehicle account. And you will debit. If they bought with cash, you write cash. If you are giving date, you put date. And this one is 260,000. And you open a cash book, cash account. All right. And this one, you credit it with land and building, 260,000. All right. So that is that. Then at the same time, you bought motor vehicle, which is 116,390. All right. And you have also a motor vehicle account. All right. Which is increasing. So you have cash 116,390. So the name here is what you should be putting to this side. The name here, what you should be putting to this side. This one too is the one you see here. This one too is the one. So when I see cash and I go to cash, I'll find the same value. So that is how we work it. All right. So basically, that is how you do the recording. So that is what you do when you purchase an asset. All right. So that is what we do when you purchase the asset. This is what you do. Everything we have outlined here. Now, what will happen is that the asset will be used during the course of the year. So within the course of the year, so after acquisition, the asset will be used during the course of the year. So within the year, so asset used within the year. So you don't just buy it and it is like that, all right? You might probably be using it during the year. And if you are using the asset during the year, the next thing we need to talk about is the first adjustment that we want to talk about is depreciation. Depreciation. Now, what is depreciation? Depreciation is allocating the cost of an asset to its useful life, or the residual value of the carrying amount of an asset to use its useful life. So here at this level, we will say allocating the cost of an asset to its useful life. We can also say that depreciation is the loss in value of an a non-current asset. All right. So here, whenever I say asset, because we are dealing with non-current asset, that is it. You can also say that depreciation is the part of the asset that has been consumed. All right. So the cost of the part of asset, an asset consumed. So the benefit that you have already enjoyed is the depreciation. Now, what are some of the causes of depreciation? Causes. What causes depreciation? And here we have level of usage. And so level of usage. So as you use the asset, the value will come down. All right. All right. So that is that. Okay. So wear and tear is also part of it. Wear and tear. So it can make the asset lose its value. Passage of time can also let an asset you lose its value. Passage of time, because there is more technology coming in. Passage of time. So with passage of time, more technology is coming in, and these are things that can cause the value of an asset to actually come down. So these are the causes. But how do we work our depreciation? So whenever you are doing depreciation, the first thing that must come to mind is the methodology of depreciation. Number one is the method. The method. Now, we have two methods in calculating depreciation. Method one, we call it straight line method. Straight line method. And the straight line method, the formula is very simple. We have basically two formulas in dealing with straight line method. Number one here is the cost, and we have learned cost today, minus scrap value. All right, like if you are selling it, what will be the residual value? All right, so the waste value. So residual value. So cost minus scrap or minus residual value all over useful life. Useful life. So if I buy an asset, and let's say I buy an asset for 100,000 on January 1, 2025, I buy it for 100,000. And I say that when I'm selling this asset after using it for 5 years, all right, which is the useful life, I'll be selling it for, let's say, let me say the useful life, let me give the useful life to be, let's say, 4 years. And I say after using it, the residual value, I'll be selling it, or the scrap value, I'll be selling it for 20,000. What will be the depreciation? The depreciation will simply be 100,000 minus 20,000 divided by 4 years. That means the depreciation for every year will be, so you will have 80,000 divided by 4, and that will give me 20,000 cedis every year. And so that is the depreciation that will be for every year. It won't change. That's why we call it straight line. So it means it will never change. So First year 20,000, second year 20,000, third year 20,000, fourth year 20,000. So it doesn't change. All right. Another way to do this is when the examiner gives you a percentage and say they do it straight line method, 10% straight line method. You will just take that percentage and multiply it on the cost. And we have learned cost. So that is that. The same cost is here. So in this case, without any useful life, and let's say the thing is 100,000 and you are giving 20% straight line method, it will just be 20% multiplied by 100,000. And that one too will be what? 20. All right. So basically, that is that. So that is one method. It's just simple, straight line method. Number two, the second method, and that is at this level, these are the only two we will do, is reducing balance. Reducing balance method. Now, how do we do reducing balance method? For reducing balance method, we will just apply the percentage on the net book value of the asset. Another name for net book value is the carrying amount. Carrying amount, all right? But how do you get net book value? How can we get net book value? Net book value is obtained by doing the cost. So you will need the cost. Of course, the cost as we have learned. Then you will less accumulated depreciation. Accumulated depreciation. The word accumulated means all depreciations from previous years put together, or all depreciations that have been charged put together. You just add them and you put them together. So let's say this is our asset. So the example that we just did, you have 20% for 100,000. So the first year, it will be the same. So the first year of a reducing balance usually is just the way you do the straight line method. So first year, you get 20,000, year one. Year one. So that is year one. And when you come to year two, you will take the 20,000, the 20%, multiply by, we said, cost minus what? Accumulated depreciation. There is an accumulated depreciation because first year you did 20,000. So second year will be multiplied by 100,000 minus the 20,000 you have done, or depreciation before. So if you do it, it will be 20% multiplied by 80. And that will give you what? 16. No, I told you that in the straight line, every year will be 20, right? Now you see this one in the second year, it is what? 16. So it is reducing, all right? Reducing. The essence is that if you buy an asset new, it has more strength than when it is getting older. So what would third year be? Third year will still be the same 20%. So that's the rate. Multiply by the net book value. What is net book value? Cost, which is 100,000, minus accumulated depreciation. What is now the accumulated depreciation? The accumulated depreciation will be 1 and 2. So that will be what? 36,000. So you will now get 100 minus 36,000. That's 64. Then you do 20% of that. So you see this one will be 12,800. So what will fourth year be? I guess now you are following. So fourth year will be what? 20% multiplied by 100 minus what? Accumulated depreciation. How many do we have now? 1, 2, 3. So that is that. 36 plus 12,800. Now that gives you 48,800. And you will less it from 100, multiply by your 20%, and you are getting something like what would that be? So 100 minus 48.8, that is 51,200, then multiply by 20%, that is 10,240. So you will see that it will be reducing. So that is how you do reducing balance. All right. The next one you need to take note when you are doing depreciation, the next thing you need to take note when you are doing depreciation is the policy. Policy of the company. Basically, there are two main policies. Policy one is on ownership. So you will depreciate the asset so long as you own the asset. So that is that. So here we say it can be, the examiner can say 1 month ownership basis. So it means that in the month that you own the asset, you will depreciate. The month that you own the asset, you will depreciate. So for example, if you buy an asset 1st January 2025, all right, and you own it till December 2025, how many months will you depreciate it? All the 12 months, all right? So you do 12 over 12. So if it is 12 over 12, it is 1. So it's like in this, our example, you would have done 20%. The first year will be what? 20% multiplied by 100,000. And since we use it for the whole 12 months, we own it for the whole 12 months. It will be 12 over 12. So this one, you can decide not to do this because it will be 1, and any number multiplied by 1 is the number itself. Now, what if I bought the asset in 1st January 2025? I own it, and by 30th June, I have sold the asset. When you sell something, please, you don't own it anymore. And so in this case, how many months will you do it? All right, how many months? So it would have been 20% multiplied by 6 over 12, then by the 100,000, or 20% of 100,000 multiplied by 6 over 12, because you only own it for how many months? 6 months. So take note of that. Okay, what if I bought the asset 1st July 2025 and I own it till 31st December 2025? What will it be? That one too will be the same. 6 over 12. So 100,000, 6 over 12, because I only own it from 1st July. So check the time. So Prof said, whenever you are doing this thing, also check what? For dates. Check for dates. Very, very important. Check for dates. All right. Then the next one, the next policy is not based on ownership. That one is full year. So we have those ones that are non-ownership based. It's not based on ownership. It's non-ownership based. So for example, if I say full year depreciation, charge full year depreciation in the year an asset is acquired, then full year depreciation in the year an asset is acquired. So long as we are in 2025, if I acquire the asset even in October 2025, and probably you are using it to December 2025, it says that charge full year depreciation. All right, full year depreciation. It is regardless of whether you own the asset, you still own the asset or not. So it says charge full year depreciation in the year an asset is acquired. So if the asset was acquired in the year, then you will charge full year depreciation, and full year depreciation is what? 20 multiplied by what? 100,000 in our example. Okay, what if it says that full year depreciation in the year asset is acquired and no depreciation in the year the asset is sold? No depreciation in the year the asset is sold. So full year when the asset is acquired, but no depreciation if the asset is sold within the year. All right, which means that if the asset is sold, you may not be owning the asset anymore. But listen to the policy. Full year depreciation, if the asset is bought, is acquired, but in the year the asset is also sold, there is no depreciation. So if I bought the asset 1st January, all right. So and you are using it, you didn't sell it, and at till December, the asset is there. You charge full year. If I buy it at July and still I didn't sell it, full year. But if I buy it 1st January and I sell it 1st February, he said in the year the asset is sold, there is no what? Depreciation. There wouldn't be any depreciation. So the policy is English. You have to understand the policy.